Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing top ship stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Top Ships is an international owner and operator of tanker vessels. The company transports crude oil, petroleum products, and bulk liquid chemicals. Its fleet consists of 100 vessels, and the company has offices in 6 countries. Let's get started with the model. This is a micro-cap company, 115 million market cap. They're trading at $2.88 a share, and they have 40 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. Revenue is the sales for the company, and that peaked in 2019 at 66 million, then dropped to 51 million in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Example are cost of labor and cost of materials. The difference between those two numbers is their gross profit. That was 21 million in the trailing 12 months. Then below that is operating expenses. Examples are depreciation, marketing, and insurance expense. Then below that is operating income. They do have positive operating income every year except in 2018. Then below that is the interest they pay in their debt. And you can see the interest they pay in their debt is more than their operating income. Then below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Then the bottom line of the income statement is their net income. And the company has negative net income every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. The company has negative free cash flow every year because they're investing so much in CapEx. But their operating income is so small relative to their CapEx. You would expect their operating cash flow to be much higher based on the amount of money they're spending in CapEx. Since the company has negative free cash flow, it needs money from somewhere to run its business. They issued $97 million of debt in 2017, then $87 million, then $260 million, then $250 million. So they're funding their business mainly on debt. They're also issuing some capital stock, 17 million, 6 million, 19 million, and 3 million. They did pay down 14 million of capital stock in 2019. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow at some point, you don't have much of a business. And you could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. They pass through a $12 million depreciation expense that brings down their net income, but we have to add it back here on the statement of cash flows. They also pass through a $15 million asset impairment. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. Even though the company reported a $15 million loss, they actually generated $10 million of cash flow. Let's look at the capital structure. 127 million of equity, 279 million of debt. They're 31% equity, 69% debt. And their WACC is 4%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value. We discounted those numbers back to today using the weighted average cost of capital. We divide that by 40 million shares, and we get a calculated stock price of 0 because you can't have a negative stock price. So I looked at every scenario. I looked at their financials. I looked at their competitors' financials. I also looked at analyst estimates, and I couldn't find one scenario where the company will be profitable in the future. This is the stock price the last 5 years, and it appears that the stock price was $500 billion at one point. Of course, it was never that high. The reason it looks that high is because they did so many reverse stock splits. Every time the stock price got to below $1, they did a reverse stock split so they wouldn't get delisted. And this company has a negative beta. That means the stock price moves opposite the market. The stock has gone down 74% in the past 52 weeks. The S&P 500 went up 17%. The 52-week low was 95 cents. The high was $15.50. And the stock is trading above its 50-day and 200-day moving average. About 18 million shares are traded on average the past 10 trading days. And of the 40 million shares outstanding, 33 million are on float. Less than 1% are held by institutions, and 5% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, after a few months you would have tripled your money, but if you're still holding on, your $10,000 is worth less than 1 penny. The biggest shareholders are Geode, SquarePoint, Sabby Management, Advisors Management, and Susquehanna International. Let's look at their financial ratios. The average PE in the market's 8.7, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 2.2, so they do have a good price to sales ratio. Investors are paying $2.20 for $1 revenue. Price to book is stock price over book value per share. They're at 0.9. They also have a good price to book ratio. Interest coverage ratio is EBIT over interest expense. They can only cover 40% of their interest payments with their EBIT. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can only cover 30% of their current liabilities with their current assets. And their current assets are $5.6 million of cash, $500,000 of receivables, and $800,000 of inventory. The company is undercapitalized. They had negative $183 million of free cash flow, and they have negative $21 million of working capital. So the company will need to issue more debt or equity to run their business over the next 12 months. The best way to look at ratios to compare them to similar companies, I've done videos on Castor Maritime and Synergy, both in the same industry as Tops. And if Tops has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples. They have the worst current ratio. All the companies have negative earnings, so they have negative ROE. They're highest in debt, and they have the lowest market cap. So to summarize, I value the stock at nothing. This is a really risky stock. The only way it seems you can make money is if you don't hold the stock too long, because over time it has only gone down. I rank their free cash flow as 1 out of 10 because they're terrible, negative every year. I rank their revenue 3 out of 10, and I rank their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.